Hi, my dear students, welcome back to ORION. In this video, today we will be discussing about Money and Banking, Chapter 3rd for CBSE Class 12. The topics we'll be discussing today are the following. Demand for money, the motives of demand for money, the transaction motive, the speculative motive, the supply of motive, and narrow and broad money. Now, first of all, let us discuss what is meant by the concept demand for money. As we all know that money is used as a medium of exchange. That is the most important function of money. Money is used for purchasing essential commodities. As well as money is the most liquid of all assets and it is universally acceptable. On the other hand, it has an opportunity cost. That means you can hold money as a cash balance at a certain point of time, and at the same time, if you put that cash balance in a savings account in a bank, you may earn some interest after a certain period of time. So while deciding on how much money to hold as a balance for a certain point of time, one has to consider the trade-off between the advantage of liquidity and the disadvantage of foregone interest. So here, since money is essential for making transactions, people prefer money in liquid form. Every day we make a number of transactions and we desire to hold money, liquid cash, for making the transaction. So demand for money is referred to as liquidity preference of an individual. We can call it as the choice of holding money in liquid form as demand for money. It is the total amount of money balances that people want to hold for certain purpose. So demand for money is nothing but the liquidity preference of an individual. Now, let us see the motives behind the demand for money. There are generally two motives, the transaction motive and the speculative motive of demand for money. The transaction demand for money refers to the demand for money to meet day-to-day transactional needs. And the total number of transactions made in an economy increases over time as income increases. See, every day we make a number of transactions. We need to fulfill all our needs. We need to buy goods and services. For example, we need to pay for tuition fees in the school, or we need to pay for a doctor. We need to purchase the essential commodities needed for our living. So here, transactional demand refers to the demand for money to meet our day-to-day transaction. But how do we fulfill this transaction or with the help of income? So income is the most important determinant of transactions. We earn income by engaging in various economic activities. Do we receive income throughout a month? No. Income is received by the workers or the people who are engaged in different economic activities at a certain point of time. So we can say that the income is not continuous. But what about the expenditure? But the expenditure is continuous. So here income is not continuous because people earn income only at certain points of time. For example, the first day of every month people receive salary. But what about the expenditure? They have to buy rice, they have to buy other the essential commodities like vegetables, fruits, etc. for their livelihood. So the expenditure is continuous, but the income is not continuous. To bridge the gap between the receipt of income and expenditure, people hold cash. Now, let us see with an example. For example, there is a worker who earns only 100 rupees per day. Now, if that 100 rupees is a weekly payment, he can settle his expenditure or he can pay all the bills with the help of that money in that week period. Or he can ask his employer to deduct his expenditure from his payment, and the worker can save the extra or the surplus money in the savings account. But now suppose, let us think that there is a worker who earns 100 rupees in a monthly basis. That is, there is a worker and there is an employer. We can imagine that there is a firm. There is only one firm in an economy which produces good, and there is a worker and a owner of that firm. So here the worker of the firm earns rupees 100 every beginning of the month, that is first day of the month, he earns rupees 100. Whereas the employer is selling the goods he's making a sales to the worker. That is also rupees 100. So, in the beginning of the month, the worker is having rupees 100, whereas at the end of the month, the employer is having 100 rupees. Now, what is the average cash holding of these two persons? The worker's average cash holding is also 50 rupees, and the average cash holding of the employer is also 50 rupees. But the total cash or the total value of total transaction is rupees 100. Here, because the seller, that is the firm owner, is selling the goods. He is making a sales to the worker, whereas the worker is also selling his skills or working his services, giving his services to the employer. So even though their averages are same, that is the value of transaction is equal to rupees 100. But here the total volume of transaction is rupees 200. So we get a surprise how with rupees 100 rupees for value, transactions value, how we can make a total transactions of rupees 200. So here we have to remember the concept that money is changing hands many times. So how many times the money changes in hand? In the example said, in the above example said by me, money is changing 2 times. That is, once the money passes from the worker to the employer, from the employer to the worker. So there is two times the money changes, and that is why the volume of transaction is rupees 200. Now let us see the relationship between value of transaction and the transaction demand for money. Children, the transaction demand for money in an economy can be written as an equation. So here MTD, that is the transaction demand for money, is equal to KT, or 1 by K into MTD is equal to T. Here 1 by K is equal to V, that is V is equal to 1 by K, and 1 that is equal to velocity of circulation of money. Here money velocity means, velocity of circulation of money means how many times a unit of money changes hands in a particular period. So, and T is equal to total value of transaction in the economy over a period of time. That is total value of the transaction, and in our example the total value of transaction is rupees 100, and K is a positive fraction. Now MTD, that is transaction demand for money, as the stock of money people are willing to hold at a particular point of time, and it is a stock concept. So here transaction demand for money is positively related to the total value of transactions and negatively related to the velocity with which money is circulated. Now let us finally see what is the relation between the aggregate transaction demand and the nominal GDP in a given year. See, there are what is the difference between nominal GDP and real GDP? Here the nominal GDP is calculated at current prices in a given year. So here what is GDP? It is gross domestic product. It is the total value of all the final goods and services produced in a particular country in a particular year or in a given year. Now the transaction demand for money in an economy can be written as the relationship between the aggregate transaction demand for money of an economy and the nominal GDP in a given year. The total value of annual transactions includes transactions in all intermediate goods and services, and it is usually greater than the nominal GDP. So the positive relationships exist between the value of transactions and the nominal GDP. So here money transaction demand, aggregate money transaction demand is equal to KPY, and that is the general equation. Now finally we have derived the general equation, that is MTD is equal to KPY. Now MTD is the aggregate transaction demand for money in the economy, and here Y is the real GDP and P is the general price level or GDP deflator. Next topic is the speculative motive of demand for money. It is a demand for money as a store of wealth. Wealth can be stored in the form of landed property, bonds, money, bullion, etc. All forms of money except money may be clubbed into a single category called bonds. We have already learned that one of the important function of money is store of wealth. So here the wealth can be stored in the form of money. Okay, J.M. Keynes, an English economist, has rightly said that all forms of except money may be clubbed into a single category called bonds. Now you should know what are bonds. Bonds are papers promising to a future stream of monetary return over a certain period of time. Now, the speculative motive includes buying, holding, selling and short selling of stocks, bonds, commodities, real estate or any valuable financial instrument. The purchase of an asset. The asset may be a commodity, goods or real estate with the hope that it will become more valuable in the near future. Is called a speculative activity. The speculations regarding future movements in interest rates and bond prices give rise to speculative demand for money. That is, if we deposit cash in saving bank account, we earn interest, and if we purchase bonds, we get monetary return on it, isn't it? So when we are having additional cash or additional money with us, we are depositing that in saving banks account as either as a current deposit or as time deposit, and we earn interest after the maturity period. And similarly, when we purchase bonds after the maturity period, we get a monetary return on it, means we get the price of bond after a maturity period. So people will either deposit cash in the saving bank account or purchase bonds to get monetary benefit. So this is the speculative motive of demand. Now people compare rate of return on bond with the rate of interest on bank deposits. It is speculation about future changes. That is, the people expect future changes. Future changes means either rise or fall in interest rates and bond prices. That resulting demand for money is called as speculative demand for money. So here once again I'll read that point, children. People compare rate of return on bond with the rate of interest on bank deposits. So people they can either save their money with a bank or they can buy bond. So here they are making a comparison on the total money return from the bank and the bond. So it is speculation about the future changes. They are expecting in future either the price might increase or decrease. So according to these expectations, they purchase bonds or they deposit money in the bank, and that resulting demand for money is called as speculative demand for money. So this is speculative activities are taking place in the money market. Now let us see the relationship between bond price and interest rate. Here the bond price or the price of a bond is inversely related to the market rate of interest. That means when the bond prices is high, the interest rate falls down. If the interest rate rises, the bond price will fall down. So there is an inverse relation between the market rate of interest and bond price. So that can be explained with the help of an example. Now let us see the example, children. Bonds are issued by the government and firm for borrowing from the public for a certain period, and that period is called as maturity period, and these bonds are tradable in the market. Now in our example, let us assume that a firm wants to sell a bond to raise a loan amount of rupees 100. Now the type of bond issued by this firm has a face value of rupees 100, and the firm, that is the bond seller, promises to give a monetary benefit of rupees 10 after 1 year. Okay, and after 2 years the bond buyer will receive rupees 10 along with the principal amount 100 rupees. That is, after 2 years the bond receive, the one who owns bond or one who holds the bond will receive 110 rupees. Now, and let us assume that the rate of interest prevailing in the savings bank account is 5%. Okay, so here we can make a comparison between the prevailing interest rate and the bond price. Now here we would like to ask a question: how much of money, if kept in savings bank account, will generate rupees 10 at the end of 1 year? Once again, listen the question. How much of money, if kept in savings bank, will generate rupees 10 at the end of 1 year? That is, according to our example, the maturity period of the bond is 2 years. But here after 1 year, the bond seller offers rupees 10. So here how much of money, if kept in the saving bank account with the interest rate of 5%, will generate rupees 10 at the end of 1 year? Now let us take this amount as X. We have to solve that X and find the value. So here X into 1 plus 5 by 100 is equal to 10. Okay, now we get the value X. that x is equal to again 1 divided by 1 plus 5 by 100. So here x is called as the present value of rupees 10 discounted at the market rate of interest. Let y be the amount of money kept in savings account. Okay, let us take x as the present value of rupees 10 discounted at the market rate of interest, and let us take y as the amount of money kept in the savings bank account, and this y will generate rupees 110 at the end of 2 years. So here after 2 years only the 10 rupee will be raised by the bank. Okay, now let us solve the equation PV, that is present value, is equal to x plus y. So after making the calculation, we get a rough figure, that is approximately we get PV is equal to 109.29. Okay, so here when we say 109.29, after 2 years to get 110 rupee as monetary return, one should keep 110.29 rupees in the bank. Okay, so that is more. Now let us consider an increase in the market rate of interest from 5% to 6%. Okay, there is a slow, a very low, little rise in the interest rate, that is 1% increase in the interest rate. Now PV is equal to x plus y. What is PV? It is the present value of rupees 10. So here PV is equal to x plus y, and after making the calculation we get a figure that it is 107.33. that is also an approximate figure. So here 107.33, that much rupees should be deposited in the bank to get a return of rupees 10 plus the principal amount after 2 years. So here we understand that when the price of the bond increases, the value of the, that is the market rate of interest, decreases. So the price of the bond is inversely related to the market rate. Now children, different people have different expectations regarding the market rate of interest and the rise in bond price. Okay, now let us assume that the market rate of interest or the bank interest rate eventually increases and reaches 8%. Finally, it reaches 8%. So that 5% interest rate is very low very low. Let us consider it as very low. So here when it is increasing, naturally the bond prices will decrease. So here when we are assuming that the interest rates have increased to 8%, we know that automatically the bond prices starts decreasing. Now the bond holders will try to get rid of the bond. So they are facing a loss. So bond holders will start getting a loss because of the price of the bond decreases. People will prefer to make additional savings in the bank at a higher rate of interest, and this situation is called as capital loss. So in such a situation, people will not prefer to hold bond and they will try to convert their money or in the savings account. So they will try to hold their cash balance in the savings account. So again, the speculative demand for money increases. Okay, speculative demand for money increases when the market rate of interest is, they are expecting it to fall down. Now again, on the other hand, again people will expect for the, that is the market rate of interest will start decreasing. So when they expect in future the market rate of interest will decrease. When it starts decreasing, slowly the bond prices starts increasing. Okay, so when the bond prices starts increasing and when it is reaching the maximum Okay, when the bond prices reaches the maximum, what happens? The bondholder starts to get capital gains. So here the bond prices will be equal to the present value. Okay, now with that we can understand by this equation, that is speculative demand for money is equal to R maximum minus R divided by R minus R minimum. So here R is market rate of interest, R maximum is the upper limit of R, R minimum is the lower limit of R. So as the market rate of interest decreases from R maximum to R minimum, the value of speculative demand for money also increases from 0 to infinity. Okay, that is when this bond prices again increases and people start buying more and more bonds, that will lead to capital gain for the bondholder, and the speculative demand for money, it will decrease. So this situation continues. Again the speculation starts and people will what happened, the people will think about a rate of interest will increase in future. But you know, this when the bond prices are increasing, when people starts buying more bonds, there is excess supply of bonds in the market. So this excess supply of bond will again lead to decrease in the bond prices. Okay, when the supply of bond increases beyond a certain limit, that is there is a money flow in the market, or money supply increases in the market. When money supply increases in the market, what will happen? People will convert their money as bonds. Okay, so when bond increases in the market, this bond supply of bond also increases in the market. So here again the pressure of bond prices, there is a pressure on bond prices and the prices starts decreasing, and this prices reaches at a minimum level. Okay, at that minimum level again people have the speculations, they start thinking that again in the rate of interest might increase, and they start the depositing money in the bank, or they prefer for holding money as cash balance in the bank account, and this will continue. And even though the rate of interest comes to a lowest point, even at the lowest point, now people are not ready to buy bonds, and that point is when it reaches the R minimum point, the curve becomes horizontal, and then people doesn't prefer to buy bonds. Instead they deposit their money, or they have their money, keep their money in the savings bank account, and at that particular point we call it as liquidity trap. And here the speculative demand for money is infinitely elastic. So and at that particular point, that point is called as liquidity trap. That is, a situation arises in the market in which after the rate of interest has fallen to a certain level, after a rate of interest has fallen to a minimum level, that is certain level means here a minimum level, liquidity preference may become virtually absolute, in the sense that almost everyone prefers holding cash rather than holding debt, okay, which yields so low rate of interest. So they prefer to hold cash in the bank instead of buying bonds. So that particular situation we call it as liquidity trap. So that can be understood with the help of this diagram, children. Now look at the diagram. There are two axes given in that graph, the vertical axis and the horizontal axis. Now the vertical axis shows the interest rate, and the horizontal axis shows the speculative demand for money. Now at the vertical axis, when R, or the rate of interest is maximum, the speculative demand for money is 0. Okay, now this curve is a downward sloping curve, and when it reaches 0, that is, you can see the liquidity trap is at R minimum. So the liquidity trap starts at a point, that is when the rate of interest falls to a particular level, that is to the minimum level. So here liquidity preference at this particular point, this preference, liquidity preference becomes absolute. So everyone who holds money prefers to hold cash in the bank rather than converting it as bonds. So here speculative demand for money is inversely related to the rate of interest, that is, higher the rate of interest, smaller will be the speculative demand for money, and vice versa. Okay, higher the rate of interest, smaller will be the speculative demand for money, and vice versa. So here the aim is to make money out of money. So here when the bond prices increase, rate of interest will fall, and when the rate of interest is higher, the bond prices will be increasing. So here money, the aim of money is to make money out of money. That is, people, either they hold money in the banks, or they can convert it as bond due to the future expectation. So this is all done as a speculative purpose, and this is called as the speculative demand for money. Now the last topic is supply of money. What is supply of money? The total stock of money circulating in an economy is known as money supply. Okay, the money supply involves currency, printed notes, money in the deposit accounts, and in the form of other liquid assets. This is the definition for money, children. Now let me tell you, who controls the money supply, or who issues money? Here the money is issued by the monetary authority of the country. RBI is the monetary authority of our country, and RBI is responsible for issuing currency notes. Coins are issued by the Government of India. 1 rupee note and coins are issued by the Government of India. So the total stock of money circulating in an economy is the money supply. Okay. The circulating money involves currency, printed notes, money in the deposit accounts, and in the form of other liquid assets. So here currency notes, when we say currency notes, here the RBI is issuing the currency notes, and if you, for example, if you take a 100 rupee currency note, you can, the value of that currency notes, that is the face value, is not equal to the intrinsic value. That is, the value of that, the money of that paper and the value of that money is not equal. Okay, that is, the commodity value is not equal. But RBI promises the bearer of that money the purchasing power for the amount printed in that money. So such type of money we call it as legal tender money. Now money in the deposit account. So the people deposit money in commercial banks. Okay, they deposit in different commercial banks and they earn interest for that. So that money, the money deposited in the savings account and current account, or and also savings account and current account can be withdrawn using checks. So checks are instruments of money. Okay, so money in the deposit accounts are also called as circulating money or money circulating in the economy. Now, measures of money supply. We have 4 categories of measures of money supply, that is M1, M2, M3 and M4. This gradation is according to the liquidity. So here M1 is currency with public, demand deposits with the banking system. So here demand deposits with the banking system includes both current account and saving account plus other deposits with the RBI, is called as M1. Now M2 includes M1 plus saving deposits of post office savings bank. Children, not only people deposit money not only in banks, but they also deposit money in post office. Post office also provides various savings facilities for people. So here M2 is M1 plus saving deposits of post office savings bank, and M3 is M1 plus net time deposits with the banking system. So what is net time deposits with the banking system? In money circulated in the economy, we include only time deposits held by the public in the banks. Okay, so that is net time deposit. Bank have other deposits, that is interbank deposits with the commercial banks, and are not included in the M3. So M3 is equal to M1 plus net time deposits with the banking system. Okay, and M4 is equal to M3 plus all deposits with post office banks. Now M1 is the most liquid money and M4 is the least liquid money. Okay, and M3 is the aggregate monetary or money which is in supply. So here narrow money, M1 is currency with public plus demand deposits with the banking system and other deposits with RBI, and this is called as narrow money. And M2 is called as M2 is equal to M1 plus saving deposits of the post office banks, and M3 is known as broad money. Broad money is M3 and M4 are called as broad money. So M1 plus net time deposits with the banking system, and M4 is M3 plus all deposits with the post office bank. So children, with this we complete money's supply. Hope you all got an idea about the demand of money and supply of money. Okay, and thank you. I want my students who watch this video to write your comments in the comment box, and please don't feel hesitated to ask doubts. You can clarify your doubts. Okay, thank you.